All right, let's have a look at real examples. And when I'm going to talk about real examples, I'm going to show you real companies and exactly explain how we eliminate that specific risk and understand that risk. And you can check it after that yourself. Now, this company called HOLLYFRONTIER. The HOLLYFRONTIER company, it's US company, and they provide it is in refining industry. Now, refining industry is very linked to oil industry and everything regarding to this sector. Now, majority of refining industries, companies who in that particular industry, they also pump oil. So they have oil fields and they get it. Now, when the oil prices go down, what happens with oil companies? They're in big trouble because the cost of production oil is still the same, but the prices are lower, and it might create the risk of bankruptcy. And you probably already heard about few oil companies which went into liquidation within the last few months, okay, in this particular case. Now, HOLLYFRONTIER is different. HOLLYFRONTIER doesn't have oil fields, so they just buy oil, they refine it and sell it as an end product. So they sell petrol, diesel, they sell different oils, they sell building materials and everything else. Now, question for you guys. Oil for them, what? Is it a cost, right? Oh, fantastic. Okay, so, and it's like a dividend yield you're talking, Rick, right, about it. So the thing is that in this particular case, HOLLYFRONTIER, when you talk about it, oil for them, it's a cost, right? But the interesting thing, when the oil company, the oil price is going down, the HOLLYFRONTIER went down with them as well in price. Why? Because people don't read reports very often. And they just sell off everything what is related to oil. They're not going to go and trying to understand the business model of the specific company, but our analysts do. We analyze the companies, okay? So that's the company's difference. So we've done it 3 years ago, the same story when the oil price collapses. And we've done recently, only just a couple months ago, same story when the oil prices, remember, went to the negative zone futures, right? So we bought this company. Some people just bought the company, hold it, but some people were selling covered calls. And I'm going to show. So this company is quality company. It's fell in price and it was undervalued at the same time. And as Rick mentioned, it's 5.3% dividend yield in dollars. So if you live in Australia and you have offset account and you save 3% or maybe something like 2% if you keep your money on the bank account, by putting just HFC, you're going to get $5% in dividends. So it's already much better. Okay, good point, Rick. Thank you very much. So let's have a look at calculation. So how we calculate. This is the option chain window. I want to show. It's a screenshot. That's how it looks like. This is taken from Charles Schwab's. Now we can see this is the, oh, by the way, you don't see my mouse. Just a second. Can you see my mouse now? Okay, fantastic. Now, look, that's HFC. The price at that time when I was taking the screenshot is $90. At the moment, the price is higher because it's already moved up. And so this is the screenshot, okay? For 3 days, okay, expiration 3 days, strike price is 20. So it's a bit higher. We can see that strike prices could be $90, $20, $21. There are different strike prices. I just left 3 to show you. And also, can you see it here? It's every week expiration. So you can sell call for 3 days, or you can sell call for 10 days, or for 17 days, for 25 days, and etc. And you can see even for January 2022. So it's for 1.5 years. Okay, so let's have a look how much you can get. Now, we'll look at 2 options, right? So for 3 days and for 7 days, or for 10 days, and then you'll choosing which one is the better for you. Now, in this particular case, we get a premium 75 cents. I'm looking at the last trade. Okay, and then we see 75 cents divided by our investment, 1931. So we get 3.8% for 3 days. Okay, that's for 3 days our contract. Now, our average share price reduced to $18.56. So if the share price continues to go down, okay, so we're still going to make money until $18.56. After that, we have a capital loss, okay, paper loss. But if you don't sell, you don't lose. You keep selling the call. You can repeat it again, right? So in order to understand with money, so if you put $100,000 in this trade, you would have received $3,880 for 3 days. Okay. Now, if the share price moves up and above $20, you, on the top of that premium which you receive 75 cents, you also get what? The difference, right? Between 1931 and $20. So because you sell it higher. So your total profit here would be $1.44 or 7.4% return on investment. Right? So if you invested $100,000 in this deal and that happened, that would be $7,450 now in 3 days. Now, guys, think about it. I know that a lot of people, they have this kind of cash in the account, and especially in Europe, if you're from Europe, it's like no income, it's negative. It's actually taking money from you for keeping the money on the bank account. So by using this strategy, you can create this amount of profit within the days. Okay, now I told you the risk here that the share price keeps going down. That's why I showed you previous slide where I explained you about the company. Could the company go low in price? Yes, it could. But we chose the correct company. We knew that this drop affected by the general market, and when the company going to report their earnings on their earnings announcement, and investors, they see that the companies keep making money, not losing money, the price will adjust and move up back. Okay, this is the important part. So let's have a look for 10 days. Here we can get $1.60 last price. Here, because I was taking the screenshot during market already closed, so that's why it's huge spread between bid and ask, but that's the last price. That's what actually happened. Okay, so buy shares, get $1.60 for the same strike price, but for 10 days, cash profit, okay, if it stays below $20, 8.2%. Okay, average share price reduced to $17.71, and if you put $100,000, that will give you $8,280 in 10 days. Okay, now if the share price moves up, so in addition to that, you get the difference. So, and it gives you $2.29 return, or 11.8% income, or $11,850 in 10 days if you put $100,000 in. Okay, guys, how clear it is? Can you put from 0 to 10 how you understand that? And if you have any questions regarding this, please ask as well. Of course. Very good question, Karen. Karen, so asking the question, so the premium rent is higher for the longer term. Correct. And it's same story. If you're renting your apartment for 1 week, you might get, let's say, $500. But if you're renting it for a month, you might get $1,500. So you're getting higher premium. But when you break down it per month, per day, you might see that the short-term lease is better. It's like Airbnb. They're getting only $100 a night, but because they're renting it for every night, they get eventually like $700 a week, not $500 a week. Okay, how important is option liquidity to you? The volume and open interest is lower in HFC. Correct. Right now, yes. Rick, it's a very interesting question, and I will explain you a bit later. Can you leave it until the end? And I will explain you how I do with that. Because every time, like probably if I quickly answer you, every time when I place the trade, I will think what kind of strategy I use. Am I using the selling part of the strategy? If the high volatility, a lot of premium, I sell option. If it is low volatility, low premium, I buy option. If it is no premium at all, low interest, I trade shares. I just buy shares and hold shares. Okay, I am not focused on one specific strategy. Even you can, but I use a different strategy, and I'll explain you a bit later how you can do that. Okay, so